Okay, so welcome back to the desk. So we just added another volatility measure to our toolbox, implied volatility. In video 6, we looked at market volatility, and in video 7, we looked at volatility, implied volatility of a single asset, and looked at how to calculate that. And I just want to make a few points here. So firstly, on market volatility, what did we look at? We looked at the S&P 500 volatility index, the VIX, and probably the most important thing to get your head around here with the VIX is that in reality, when you have a portfolio, your risk increases as the VIX increases without you doing anything, okay? It's probably the most important thing that you have to get your head around. And also, of course, vice versa. When the VIX is decreasing, when market volatility is decreasing, your risk is falling also without you doing anything. So if you are in at any one stage a long-short portfolio, to get outsized returns, you actually have to do something. Of course, as long-short portfolio managers, we outperform on the way down. But if you want to get in an absolute return mandate, outsized returns on the way down as well as up, you actually have to do something. You actually have to act. So remember, get your head around this concept. Risk goes up, okay? In the market, your risk in your portfolio goes up. But what happens to the flip side of the coin? What happens to opportunity? Well, it doesn't necessarily go up because you can actually get caught out and be on the wrong foot. So if you're overly long at any one time in your portfolio and market risk goes up, if you don't do anything, you can actually get caught out. So risk going up doesn't necessarily mean opportunity goes up if you don't do something. You have to do something about it, okay? Now, on the flip side, if volatility in the market is going down, so let's say you're currently trading quite short term in the market, volatility is high, and risk is going down, okay? That doesn't necessarily mean that opportunities are going to go down, okay? Yes, the volatility in the market is lower, okay? But if you actually do something and you switch from being a trader to a long-short portfolio manager and you extend your time horizon, that's when opportunities are going to increase for you, okay? So you have to understand that this is a dynamic world. The VIX increasing and decreasing does increase risk and decrease risk, but not necessarily automatically increasing opportunities. You actually have to go and do something about it. We live in a dynamic world. Now, just on a side note, VIX hedges. What you have to understand here is that these financial instruments have been built and marketed around this concept that they are going to solve the problem that if the VIX rises and you have, for example, a long portfolio, you don't have to do anything. You are naturally hedged. However, because of the way these instruments trade, the way they operate, these VIX hedges, or what they are marketed as hedges, aren't necessarily hedges. They're not really going to protect you over the medium to long term in your portfolio. So again, what has to happen here is that you have to recognize that volatility is moving, whether that's going up or down. You have to look at your portfolio at that moment in time and then realize what the opportunity is and actually go and do something about it. But of course, like I said earlier, if we are running long-short portfolios, of course, we're probably going to outperform everyone else on the way down when risk in the market goes up. So for us, it's probably a positive thing, but only on a relative basis compared to other people who are losing a lot of money because they are only long, okay? If we actually walk into a situation like that with a long-short portfolio, and on top of that, we recognize what the opportunity is, and we take the steps that we need to take to actually take advantage of the opportunity, that's when we get big outsized returns in the absolute return mandate. And of course, also on the flip side, when we recognize that volatility is going down, we recognize we're in a much more conducive environment towards long-short portfolio management. We can have a net bias, long bias in our portfolio, and we can get outsized returns on the way up as well. So we recognize what the opportunity is there with market volatility, and we do something about it, okay? Now, second point I want to make here, implied volatility. When we compared mid caps again to mega caps, when we looked at implied volatility, when Chris was taking you through the implied volatility calculations, we again saw, like distribution of returns, like ATRP, that we're going to lean towards the space in the market in the 1 to 3 month equities, long, short portfolio management. Okay. So you now have 3 volatility measures. We have 2 historical or realized measures. We have our distribution of returns and we have our ATRP. And we have our future implied expected volatility measure, which is implied volatility. So these are the 3 main measures that you must be using on a continuous basis to become much more proficient in financial markets, get yourself up the competency hierarchy, and trade to a more professional standard. These are the 3 main measures that professional traders are using all the time. So if you use them in combination with each other on any single asset, what's going to happen? Well, you're going to be able to understand and appreciate that particular market a hell of a lot better than anybody else. You will know your risk and opportunity, and you can literally choose if you want that or not. Okay. So now we're going to move on to portfolio volatility, and we're going to look at expected future or implied volatility of a portfolio. This is going to be the final lesson in the IPLT video series. And there's 2 major things that you have to take away from this part of the video series, the last part of the video series. If we can get, like we mentioned earlier in the video series, if you can get and measure the data on a single asset and measure the volatility of that data on a single asset, we can get it for a group of assets, okay? And a collection of a group of assets is simply called a portfolio. So understand that, okay? Through correlation of these assets, and this is something that we're going to take you through now in the next 2 videos. We're going to take you through correlation. And through this method of correlation of this group of assets that we call a portfolio, we can get the implied or expected annual level of portfolio volatility. That's the first thing to get your head around. Second, we can choose the level of risk and opportunity that we want in a portfolio. So not just the level of risk and opportunity in a single asset, but a group of assets, a portfolio. That's the second thing to get your head around. As traders and portfolio managers, we are always aiming to get the highest amount of return from the lowest possible amount of risk, regardless of whether the market goes up or down. This is the absolute return mandate. And in the next 2 videos, you're going to see how all of this fits together. So in video 8, I'm going to take you through a whole bunch of concepts for portfolio volatility. So in this video, we'll be going through all of the concepts of portfolio volatility. And then in video 9, Chris is literally going to go through a spreadsheet class again, and he's going to show you how to calculate portfolio volatility. So let's get into it. Let's get into this video, and then we'll go straight into video 9, and then I'll see you back at the desk in video number 10 for a review of everything and some next steps. Okay guys, welcome back. Welcome to video number 8. So we're going to move on now to look at portfolio volatility in this video. But first, let's have a quick recap of what we've looked at so far. So far, we've looked at realized volatility, so historical volatility, by using some tools. We've used distribution of returns analysis and average true range percent on multiple individual market instruments. And we came to a number of conclusions and acquired those tools to help us assess both opportunity and risk. So we're looking at the risk of individual assets, stocks, and coming to a number of conclusions. And we're looking at potential opportunities, so expected future returns over multiple different time horizons. And in the last video, Chris did a very good job of looking at implied volatility. So looking at the expected future volatility of an asset that's priced into the market right now. So on a single asset, utilizing the options that are traded on that asset. But it stands to reason, guys, if we can calculate volatility, whether it's historical or implied, on single assets, what if we put a whole bunch of assets into something called a portfolio? Well, as traders and long-short portfolio managers, we can also calculate the volatility of our portfolios. Okay. Now, why do we do this? Well, we do it because we want to choose the level of risk that we want to take and choose the level of opportunity that we want to expose ourselves to in order to get returns that we're targeting. Now, professional traders, and this is another difference between pro traders and retail traders, pro traders are aware of the risk and opportunity that we're taking. And retail traders generally don't have a clue. Retail traders are taking a very scattergun, scatterbrain approach. It's just a skill set that they don't have. Professional traders, we are targeting consciously certain levels of risk and return in our portfolios. And retail traders obviously aren't, because retail traders aren't even building portfolios to begin with. Now, in the same way that we have variability and volatility in a single asset, we have variability and volatility in a portfolio. Therefore, if we have that variability and we have volatility in something called a portfolio, which is just a collection of assets, we obviously have both risk and opportunity in a portfolio. Now, like a single asset, say a stock, portfolios can be obviously high risk, they can be low risk, they can be everything else in between, they can be medium risk. So again, it stands to reason that if we're going to have volatility in a portfolio, similar to the way that we have volatility in a single asset, that we can actually consciously go and choose the level of risk that we want in our portfolio, similar to the way we choose the level of risk in a single asset. So we're obviously going to get higher expected returns from higher risk portfolios versus lower expected returns from low risk portfolios. Why? Because the upside and the downside is greater in risky portfolios versus low risk portfolios. Now, this all seems like fairly obvious stuff, right? Of course, you're going to get potentially higher returns on risky portfolios than low-risk portfolios, of course. So it all seems fairly obvious stuff. But, this, when we're looking in a portfolio context, it isn't obvious to retail traders because they don't build professional level long-short portfolios. And most importantly, they don't know how to calculate risk and expected return properly. So understanding portfolio volatility, knowing how to calculate the risk of a portfolio, knowing how to calculate the expected return properly is very important because that enables you to take the professional approach to build professional level long-short portfolios. That's why it's so important. Now, remember, we are building long-short portfolios here. We're not building long-only portfolios. We want diversification, okay? There's two main reasons we build long-short portfolios. Of course, and we've covered this before, we want to make money when the market goes up and when it goes down. But also, as mentioned, for diversification purposes, the all-important preemptive risk management. So a combination of these things is required. This is why we build long-short portfolios. So we want to make sure, this is the main reason for diversification, okay? We want to make sure that when we're wrong on a position, which is of course going to happen, it is absolutely inevitable that it's going to happen frequently throughout our careers. We want to make sure that when we're wrong on a position, that not one single position in the portfolio can wipe us out or kill us, okay? But diversification is a catch-22. We need it because we want to make money when the market goes up and when it goes down. So we need diversification from the long-short perspective. But we also want to make sure that we are exposing ourselves to making money. So this is a push-pull situation. So we've got to diversify enough to a point where we're not being stupid. So we're being too concentrated in our portfolios, so taking too much risk. But we don't want to be too diverse that we can't expose ourselves to making high returns. So what do? Well, we take on diversification in the long-short context, and we target a level of risk that we want to take to get the returns that we're seeking. Now, this is sometimes called or referred to in theoretical finance as the efficient frontier. The efficient frontier is essentially a point where you're taking enough positions where you are diverse enough that you're not too concentrated and you're not being too stupid. And one of those positions could actually just go very wrong and wipe you out or cause a very big drawdown in your portfolio. So you're not being stupid and being too concentrated, but you're not being too diverse where you can't make high returns. So obvious question, how many positions do you take? Well, we're going to come on to that later. Don't worry about that right now. We're just going through a few definitions here and building up slowly but surely all of these concepts so they stick. Now, realized portfolio volatility. Obviously, earlier we looked at historical realized volatility with distribution of returns, an average true range percentage, and we also looked at implied volatility in single assets. Okay. Realized portfolio volatility is done in the same way as for a single asset. Okay. So when we looked at distribution of returns earlier and average true range percent, the same methods can be applied. And we run a distribution of historical returns on a portfolio, and we calculate 1 and 2 standard deviation moves. Okay. So the main method we use is the distribution of returns. Okay. The 1 standard deviation and 2 standard deviation percentage values is, by definition, the realized historical risk of the portfolio. Now, we're not going to cover in the video series how to run a distribution of historical returns on a portfolio, because what we're really interested in is expected portfolio volatility. We're interested in what's the volatility that we expect in the future of a particular portfolio when we model that portfolio. So you can take a collection of assets, obviously, take the historical data, put weightings on positions, and figure out the distribution of returns of that portfolio. But we're not going to do that in this video series. You'll see later why when Chris Quill in video 9 goes through expected portfolio volatility. But what we're really interested in with expected portfolio volatility, with this method, is really understanding what to expect from a collection of assets in the future, not necessarily in the past. So this is a much more important method to get your head around, okay? So for expected portfolio volatility, we use other statistical methods to forecast it, to forecast our future volatility of a given portfolio, so the future risk and opportunity of that portfolio. But what we do is we use historical asset prices to calculate it. We use historical prices to calculate the expected future volatility of a portfolio, a collection of assets, a bunch of stocks, okay? That's all a portfolio is, a bunch of stocks, long and short. So the statistical methods we're using, we're looking at variances and covariances, and we're applying weightings to each stock in the portfolio. What is covariance? Well, covariance measures the relationship between two assets. Correlation is basically covariance normalized with a value ranging from +1 to -1. And it can be expressed as a percentage value. So +100% to -100% correlation. Now, don't worry about these definitions too much at the moment. You're going to go quite deep into this in video 9 when Chris Quill gives you the spreadsheet class. You'll see downloads under video 9. You'll see the video 9 download called Portfolio Volatility Calculator. Chris will take you through that, and you'll begin to understand correlation, covariance, and portfolio volatility a lot more in depth. For a basic guide on correlation and covariance, go back to video number 2 and download the basic statistics guide. You can brush up ahead of video 9 on the basics of variance, covariance, and correlation from that statistics guide in video 2 downloads area. Now, practically using historical data to calculate expected future volatility of a portfolio, why is it actually important to calculate it? What are we doing here? What's the purpose to practically go through this exercise? Well, it's important because we can model different types of portfolios. And what do we mean by different types of portfolios? Well, portfolios with different levels of volatility, so risk and opportunity, and with different correlations. Once we've been through that practical exercise and we know how to do it on repeat, for the rest of our lives, we can choose as traders or portfolio managers where we want to sit on the risk curve. What level of risk do we want to take? What level of opportunity do we want to expose ourselves to? It's important because we're not going into the market blind without it and not knowing what level of risk and opportunity we're exposing ourselves to. We know the level of risk and expected return that we are targeting. It's very important. Now, when you go through the spreadsheet class with Chris, he's going to present a theoretical portfolio to you, where we're looking on the left-hand side, the volatility, so the left-hand axis, vertical axis, portfolio volatility expressed as portfolio standard deviation. So like we looked at in with previous tools, where we're calculating standard deviation, we can do that on a portfolio too. And then we're looking at that compared to the x-axis, the horizontal axis, with the number of positions in a portfolio. Okay. And Chris will take you through this. It's important to understand, here we've got a theoretical portfolio with equally weighted assets and variance and covariance in the portfolio. And you can see in this portfolio, model portfolio, that essentially the more positions you take, the lower the standard deviation of the portfolio. But it's important to remember that when you get to a certain point on the curves, when you get to a certain point, diversification, so more and more positions in the portfolio, doesn't lower the standard deviation of that portfolio. It's just an important concept to get your head around while we're learning and understanding what it means to have portfolio volatility and understand the efficient frontier. But what else do we discover when we model portfolios? Well, when we're looking at stocks and we're looking at different market capitalizations of stocks, as we've seen earlier, higher market cap stocks are less volatile than lower market cap stocks. So higher market cap stocks of mega caps and large caps are less volatile than mid cap and small caps. So when we model these portfolios, what do we expect to find? Well, what actually happens, and it comes out as expected, is that long only mega cap and large cap portfolios are less volatile than long only mid cap or a mixture of mid cap and large cap portfolios. So that's as expected, guys. We would expect to see that. However, we are not long only portfolio managers. We are long short portfolio managers. We want to make money when the stock market goes up and down. So we've got to look at our portfolios and model portfolios in the context of a long short diversified portfolio. When this happens, correlation becomes very, very important. Okay. So what do we mean by correlation? Let's understand this. Well, a correlation of 1 or 100% means everything in the portfolio moves up and down together. So what would that mean for a long short portfolio? Well, all your longs go up, all your shorts go up, all your longs go down, all your shorts go down. Okay. For us as long short portfolio managers, that's pointless because it replicates a long only portfolio. And even a high correlation of say 0.8 or 0.6 is also pointless. Basically, if you're in the long short context, if you're long the wrong stuff and short the wrong stuff, and they all move up and down together, you're just going to blow up very quickly. So your shorts go up more than your longs, for example, or your longs go down more than your shorts. That can happen as well. You can just blow up very quickly. Now, a correlation that's negative is very different. So we want to try and avoid having high positive correlation in our long short portfolios. A negative correlation is different. That means everything moves in the opposite direction. Now, in theory, this would be pretty good for diversification purposes because it means our diversification is working. It's incredibly efficient. But in reality, when you're building a long-short portfolio, to get negative correlation that's -1, so perfect negative correlation, is just mathematically impossible. So think about the basics like this, okay? If we take two stocks that move in opposite directions all the time, that's great. As long-short portfolio managers, we like to see that, okay? We want to be long the one that goes up and short the one that goes down. Negative correlation exposes us to this possibility, whereas positive correlation Well, high positive correlation doesn't, okay? So we have two stocks that move in opposite directions. Fantastic, we like that. Box ticked, okay? But what happens when we add a third stock into the portfolio? Well, mathematically, the average correlation can no longer be -1. Mathematically, it just doesn't work, okay? So what happens when we keep adding stocks to the portfolio? We keep adding longs and keep adding shorts. Well, the correlation is just going to keep changing, okay? But we're never going to have a situation where we have really low, really negative correlation in long-short equity portfolios. So coming at this realistically, in long-short portfolios, the aim is to have an average portfolio correlation that's not too far away from zero, okay? That's the best we can do in the real world, okay? Small positive average correlations should really be expected in portfolios that are biased with a greater number of either long or short positions. So for example, in a 10 stock portfolio where your weightings are either equal or fairly close to equal, if you have 6 longs and 4 shorts, or 6 shorts and 4 longs, you would expect to have an average positive correlation. And we want that positive correlation to be not too far away from zero. So we don't want to be wildly positive with correlation in our portfolios. So what else have we got to talk about? Well, long-short portfolio mandates. Part of the reason we approach the market with a long-short mandate is because, as you can tell from the charts that we looked at just previously, it lowers portfolio volatility, okay, the more stocks we have because we're diversified, okay? But we have two competing factors that we have to consider. Firstly, our desire to get outsized absolute returns. And secondly, our desire to control risks. So what are we doing here? We're diversifying in the catch-22. We're trying to be at the efficient frontier, okay? We are choosing the level of annual risk that we want to take and targeting an annual expected return from that risk. That's called a Sharpe ratio in the business. Your expected return or your return over the risk that you've taken. So we're aiming to get the highest amount of return possible from the lowest amount of risk possible. So we're looking to maximize our Sharpe ratio and make money regardless of whether the market goes up or down, because we have the absolute return mandate. And of course, we still, however, always want to be doing way better than the stock market returns. So this push-pull factor that we have to always be mindful of, where we have our desire to get outsized absolute returns versus our desire to control risk and therefore maximizing Sharpe ratio. What does that look like in reality for retail traders? Well, let's have a look at different levels of margin capital that are deposited into trading accounts by retail traders. Now, retail traders with small levels of margin capital, so let's say $25,000, $50,000, $100,000 deposited on margin into a trading account. Typically, what it looks like is an amount of positions that is between in a range of 8 to 12 positions. Below 8, you're becoming too concentrated. Above 12, you're becoming too diversified. So this is the push-pull range for retail traders with $25,000, $50,000, $100,000 of margin capital in their portfolio. Retail traders with larger levels of margin capital, so this would be considered a fairly large retail trader. So $250,000, $500,000, $1 million deposited in the trading account. It's 10 to 14 positions is the range. Below 10, you're becoming too concentrated. Above 14, you're becoming too diversified, where it's going to become very difficult to get a variability, a standard deviation in your portfolio that allows you to target the opportunity, allows you to target the expected returns that we're looking to get. So the absolute return mandate, and also looking for returns when the market goes up and down that are way higher than the market, okay? So 10 to 14 positions for 250, 500, $1 million, okay? Now, big retail traders, $2 million to $5 million. These are professional levels of margin capital. This is the lower end of pro level, okay? But obviously the very high end of retail trader capital, okay? 2 million to 5 million, we're looking at 12 to 16 positions. Now, why does this go up? Well, if you're trading with $25, $50, $100,000, you need to be a little bit more concentrated to make meaningful money. Of course, as you make more money and you get onto higher levels of capital, you become slightly more diverse. So basically, one of those positions, if it goes wildly wrong, can't blow you up. On lower levels of capital, you're happy to take a little bit more risk because you want to grow quicker, okay? So when you're a smaller retail trader, we're taking a little bit more concentrated risk than if we're a large retail trader, okay? Also, we have to think about the reality of the situation here. As we've discussed many times over, retail traders have other activities that they're doing in their lives. Smaller retail traders have got full-time or part-time jobs, running small or medium-sized businesses, have hobbies and interests, have families. There's lots of other things that you're doing during the week, and there's only a limited amount of time. And what happens when you're trading larger amounts of capital, you have to dedicate more time to it because you have to be slightly more diverse. Therefore, you're having to come up on a regular basis with more trade ideas and trade the portfolio more actively. So it stands to reason, given all these factors, that when you're a small retail trader, you're happy to be a little bit more concentrated, even though 10 positions or 12 positions is still very diverse. You're taking a very sensible approach. But as you grow, you're going to be putting in more time trading the bigger numbers. And when you're professional level, you are looking at around a portfolio of 14, 16 positions at any one time. Now, remember, these are margin levels and these numbers are going to be leveraged. So therefore, the risk and return that we model on these portfolios is going to be leveraged too. Now, we're going to run through some examples here of what portfolios in the US and the rest of the world would look like in terms of the ranges of volatility that we're looking for, risk and expected return, expected future return that we're going for. So let's have a look first at a typical retail trader in the US that trades with ITPM, okay? So a US equity options portfolio manager with margin capital of between $25,000 and $2 million. What are we targeting here? What are we trying to target in terms of expected annual portfolio volatility? We're looking at 15 to 30%. Now, it's important to understand that it's the underlying portfolio. This is not the expected annual portfolio volatility of the options portfolio. This is the underlying stocks, okay? So when we put those stocks into a spreadsheet, as Chris is going to show you, and the number pops up for the underlying volatility of that portfolio, the number that we're looking for is the low end, around 15, the high end, up to 30, okay? And what are we using options for? We are using options to represent the actual trade idea, okay? So the underlying portfolio, volatility of 15 to 30%, and then utilizing equity options to get leverage on those trade ideas. So instead of buying a stock or shorting a stock, we're expressing the long by buying call options or putting on a call option structure. And instead of shorting a stock, we are either buying put options or putting on a put option structure. So what actually happens when we leverage this expected underlying portfolio volatility with options, we end up with what's called implicit leverage, because an option, when exercised, you'll end up either owning or being short the stock. Okay. So the option gives you implicit leverage on the stock position. So relative to having a stock position of 3 to 10 times the underlying stock position that you would have taken if you'd have invested the same amount of money in the underlying portfolio. So implicit leverage of 3 to 10 times. So we're going to be somewhere in that range of 3 to 10 times. So what does that mean? We end up with a range of possible outcomes in the portfolio from the underlying 15 to 30 of 45 to 300% annual return. But we have to be realistic here. Okay. What are we going to target? We're obviously not going to put our expectation of making 300% return. So we want to be at the bottom end at least, and we want to be targeting probably around 50 up to 100% annual returns if we're going to be leveraging the 15 to 30 with equity options. Now, of course, it can be higher, but we have to be realistic. So what does this mean? It means you're basically getting 3.3 times the underlying portfolio volatility if you're taking the realistic target of 50 to 100 when utilizing options and leveraging the 15 to 30% underlying volatility. So what does that mean? Your Sharpe ratio that you're targeting is above 3. It's 3.33 in this particular case. But of course, it can be higher, and we have traders that get higher. Okay. Portfolio correlation. What are we looking at? Well, we're expecting to be, or targeting, we want to be around 0, and we expect to see it in the positive most of the time when we're running our equity portfolios. We're looking at a range of plus 0.3 to negative 0.3. Okay. Now remember, this is regardless of whether the equity market goes up or down. We really don't care what the market does. We just want to make money. We are absolute return traders, portfolio managers, but we are taking a measured and sensible approach by calculating, modeling a portfolio that provides 15% to 30% expected annual portfolio volatility for the underlying stock portfolio, then utilizing options to leverage those numbers to get a much higher expected annual return. Now, what about guys in the rest of the world? So international traders, rest of world retail traders outside the United States. Well, we've looked at these before, contracts for difference. Most of the time, retail traders would be trading CFDs, CFD portfolios outside of the US, similar value of margin capital, 25,000 up to 2 million. And we're looking at this in the same context. We're looking at it at exactly the same portfolio, expected annual portfolio volatility of 15 to 30%. Okay. CFD traders in the rest of the world, what type of leverage can they get? Well, typically they can get around 5 times leverage, but that would be you absolutely maxed out. A more sensible approach is to look at 4 times. So if you stick $25,000 in a trading account, what's happening? You're going to have $100,000 of exposure to the 15 to 30% expected annual volatility. Okay. Same for 50,000, 100,000, 250, 500, a million, 2 million. Okay. And with the amount of positions that we've discussed. Okay. So you're going to be leveraging that 4 times. Now, what does that give us? A range of possible outcomes of 60 to 120% return, annual return. Now, What are we targeting here? Well, we're trying to be as realistic as possible. It's much harder to trade a CFD portfolio that's 4 times leveraged than actually trade an options portfolio. And we'll come on to that in a second. But we're being realistic. We're targeting 1.5 times portfolio volatility, so a 1.5 Sharpe ratio. We're targeting from the bottom end 22.5% annual return, and on the higher end 45% annual return. Now, of course, it can be higher, but we're just trying to be realistic here. So when you're trading a CFD portfolio, a Sharpe of 1.5 and getting returns in the range of 22.5 to 45% annual, so 1.5 times portfolio volatility is realistic. And again, we're still trying to target the correlation of positive 0.3 to negative 0.3. And of course, it goes without saying these days, this far in the video series, it's regardless of the equity market going up or down. We don't care. We just want to make money. Now, why is it more preferable to be leveraging this expected annual volatility with options than just trading with CFDs? Well, let's have a look. It's a bit more difficult to get higher returns from the same portfolio volatility with CFDs versus options for a number of reasons. Firstly, implied leverage. This is the amount of contracts you can get, you can trade when you're trading options. Okay, so the amount of contracts that you go long, calls and puts, and also we'll discuss spreads in a second. Short contracts that comes into play as well. But implied leverage, basically, as a trader, because you can expose yourself to low-priced options and get many contracts equivalent onto the book. Traders can expose themselves to much higher implied leverage versus the equivalent dollars of margin that a CFD trader can expose themselves to. Okay, so the implied leverage that you get when trading an options portfolio versus a CFD portfolio can be much higher. Okay. Secondly, options bring in risk asymmetry. So think about it like this: if you believe a stock is a buy and you think the stock's going up, you want to be long, and you do that in a CFD portfolio with a certain amount of dollars. Okay. What can happen? Well, the stock can go up. You can make a certain amount. The stock can go down. You can make a certain amount. But it's just up or down. And the up or down is probably going to be very similar. So the outcome is going to be similar with a 50-50 probability if you've not stacked the odds in your favor by doing amazing trade idea generation. Okay. So what options do is it brings in risk asymmetry. So when you're exposing yourself to a stock, just long or short, your dollar upside can be the same. Your expected dollar upside can be the same as your dollar downside. Okay. With options, that's not the case. You have limited downside on long calls and puts versus going naked long and naked short stock itself or a CFD. Okay, so on call options, you've got limited downside. When you're buying a put, you've got limited downside. It's limited to the premium that you spend. Okay, your loss is limited to the premium that you spend. On naked longs, you have large downside because something can go to zero. And on short stock positions, you have unlimited downside because theoretically, something can go to infinity. On top of that, when you're trading a CFD portfolio, you've got gap risk. Okay. So yes, you can try and set stop losses on longs. You can try and set stop losses on shorts, but something can happen when the market is closed. You come in the next day and a stock just moves wildly against you and trades at a level that's way through your stop losses. Okay. With options portfolios, you don't expose yourself to that gap risk on CFD portfolios you do. So for a couple of reasons, there's risk asymmetry brought into a portfolio when using options. Third, options portfolios provide, on average, higher ROI because we can expose ourselves to more sophisticated structures like options spreads. And option spreads reduce the dollar volatility of positions in the portfolio and increases overall portfolio return on investment, ROI. So for these three main reasons, this is why options portfolios provide a better risk return profile than when you trade CFDs. So if you're interested in that, this is something we can't really cover in the IPLT video series because it goes very, very in depth. And it's to do with trade structuring. It's not really to do with introducing you to the way professional traders do things. The IPLT, the clue is in the name, is an introduction of how we do things and the differences between professional traders and retail traders. If you're interested in really learning about how to build and structure options portfolios and options trades, you've got to do the POTM video series. But really, the POTM should be taken in combination with the PTM. Now, let's go back to the US. What about guys in the US who trade stock portfolios? Well, unlike the rest of world traders who trade CFDs, CFDs are not available in the States. They were banned years ago. Guys in the US who are long short managers, stock portfolio managers of 25,000 to 2 million margin. What are these guys doing? Well, these guys can only get 2 times leverage overnight, okay, which reduces the range of possible outcomes in the portfolio from the same portfolio. So we're looking at the same portfolio here, 15% to 30% expected annual volatility, 2 times leverage available to guys in the US who are long short stock portfolio managers. The range of possible outcomes, 30 to 60%. So we're targeting that number, 30 to 60%. And it's questionable whether that's realistic for retail traders, especially when starting out. Why? Because it's 2 times portfolio volatility, which means you're going to need a Sharpe ratio of 2. Now, of course, it can be higher. You can just have a fantastic year. Get the upper end, which is 2 times portfolio volatility or higher. But it's not realistic. It's, if you're looking as a retail trader to trade portfolios of 15 to 30% expected annual volatility with only 2 times leverage overnight, it's pretty unrealistic to expect 100% plus returns. Okay. These types of returns, as you can see on previous slides, can only really be expected from options portfolios. So 50 to 100% return where you can get it consistently, or someone who's really good at trading CFDs. But even if you're really good, guys, it's very, very hard in the US with only 2 times leverage. A retail trader in the US deploying the long short strategy, if you compare them 2 times overnight leverage stock traders to 4 times CFD traders, someone in the US deploying this strategy would have to be a much better, open quotes, trader, close quotes, than a rest of world CFD portfolio manager to get similar returns. So if you recall, the CFD trader is looking at a 1.5 Sharpe ratio, okay? To get a range of possible outcomes around the 60, within the range of 60 to 120%, okay? But realistically targeting the 22.5 to 45%. So the Sharpe ratio of 1.5, targeting 22.5 to 45% versus the 2 times leverage guy targeting 30 to 60%. So they're falling roughly in the same range, but this guy, the guy in the US, needs a higher Sharpe ratio. So a retail trader in the US deploying the strategy would have to be a much better trader than the CFD guy in the rest of the world. So what does that really mean to be a better, open quotes, trader, close quotes? Well, it just means for the same portfolios versus a CFD trader or even an options trader for that matter. The US long short stock portfolio manager targeting the Sharpe ratio of 2 is just going to have to be much better at trading the range of possibilities. So what does that mean? Well, we're just looking at a portfolio here, a collection of assets, a collection of stocks, and they have ranges, they have variability. So you'd have to be trading out much closer to highs and much closer to lows and being a much more efficient trader than guys in the rest of the world trading CFDs or options portfolio managers, okay? When trading exactly the same portfolio. So they'd have to become a much better trader. Now, when we've looked at these three types of guys, the options portfolio manager in the US, the rest of world CFD long short portfolio manager, the US long short stock portfolio manager, when we've looked at these guys, they're all trading the same portfolios, but we're making some huge assumptions here, okay? We are making the assumption that you actually have a trade idea generation process in place that allows you to consistently select good longs and shorts in the 20 to 60 day time horizon. None of it is possible, guys. None of it is possible unless you have that skill set, okay? And that's where the PTM video series comes in, the Professional Trading Masterclass. So, for your further education, further study, there are further video series that need to be done to get you up the competency hierarchy. What else do we assume here? We're also assuming, if you're targeting these types of ranges and these types of returns, okay, we're also assuming that you're actively trading the portfolio and you're doing it well with good execution and frequently staying in motion. So you're not just sitting there and staring at your portfolio, okay? And then when the portfolio is making money, you're doing nothing. When the portfolio is losing money, you're doing nothing. You're actually actively trading the portfolio and getting good execution and frequently staying in motion. So what does that mean? It means you've got good execution and good reactive risk management. You are trading your positions actively, okay? Now, this is part of the PTM video series and ITPM mentoring programs. So unfortunately, there's only so much you can learn from a video series. When you're climbing the competency hierarchy, you're going to have to trade with real money and you're going to have to do it well in order to become competent, okay? You can't claim to be competent at trading unless you've got experience, okay? You've got to be implementing and doing well. That's where an ITPM mentoring program comes in. 12 weeks with one of the senior trading mentors at ITPM and implementing with real money and learning how to do it properly and getting experience, okay? For options portfolios, we've made another assumption here. You can't have any of those possible outcomes that we looked at with options portfolios in the US unless you really know how to trade options, okay? Unless you know how to structure trades properly utilizing equity options. And that is the POTM video series. So, to further your study and further your education and to continue climbing the competency hierarchy, there's resources available at ITPM. What we're doing here in the IPLT video series is helping you get from the lowest level of the competency hierarchy, unconsciously incompetent. We're just starting you on the journey. What we're doing is here is we're showing you how professional traders approach the markets so that you can take that away and potentially emulate some of the processes that we've given you here for your own retail trading account. And that will start you on the path to becoming more competent. What we're essentially doing, and especially with the spreadsheet classes that Chris is providing, what we're essentially doing is practically demonstrating the differences between retail traders and professional traders. And it's all anchored in volatility and time horizon, okay? Risk, return, the risk you're taking and the expected return that you're exposing yourself to, okay? And what you're seeing now is the differences in action. You can actually see, you can definitely now see that there's a stark contrast and difference between the way we do things and the way retail traders do things. Now, after completing video 9, where Chris is going to give you the spreadsheet class on portfolio volatility, you're not only going to know exactly the differences, but how to model professional long-short equity portfolios. And you'll be able to do that forever for yourself. It's a very, very valuable skill set. But, it's a long, hard slog learning how to trade, okay? Learning how to trade in the same way that professionals do. It's a long, hard slog. And it's just information. You've got to learn this information and climb the competency hierarchy. What you're doing now is you're actually leaving the level of unconscious incompetence and you're becoming unconsciously competent. So keep going, guys. I know it's a long, hard slog, but you just got to stay motivated. Try to really understand these pro trader processes. Chris is going to show you now in video number 9 how to operate the portfolio volatility calculator and understand what it all means. Just as a side note, everything we're teaching you here from ITPM in the IPLT video series, all of the teachings and processes and throughout all of our video series, they are timeless processes, okay? The teachings that we're providing you and the processes that we're giving you and the resources, they can be used and applied in all market conditions forever. If you're watching this video series in the year 2027, in the year 2040, it doesn't matter. Everything you're learning here in the IPLT and across all ITPM video series, it's all timeless, okay? So when you're watching portfolio volatility calculator, when you're watching the portfolio volatility calculator spreadsheet class with Chris, just think about what you're watching. You're watching processes that you can apply to building stock portfolios at any moment in time. It's a really, really useful tool to have, okay? And it's really going to show you, and the processes will really show you the differences between professional traders and retail traders and the way we go about things and how different it is to the way retail traders do things. So enjoy video number 9. I'm going to be back with you in the final video, in video number 10, and we're going to go through conclusions and do a summary of the entire IPLT video series and all of the most important lessons to take away.